Hey guys, so this is a new strategy for a 200K investment, a dividend income portfolio investment. I want some margin of safety, so I'm putting 50% into JAAA and JBBB. They definitely are more stable during corrections. JBB I think can go down a little bit more because it's B-rated type of bonds, or not bonds but CLOs. And then I'm going to have a definite core in the QQQI, SPY-I, MLPI, PFFA, ASGI, UTF, and THQ. Basically, I have the indexes. Then I have energy midstreams, basically for MLPI. PFFAI is preferred shares. ASGI is like a world infrastructure fund. UTF is utilities infrastructure. And THQ being healthcare. And for BDCs, I decided to add some quarterlies in there, ARCC, TRIN, HTGC, OBDC, because I plan to get in on those by doing almost like a will strategy, where if I get a sign and they start topping out looking kind of overvalued on the chart, I might occasionally sell out of the money cover calls too. Not a true will strategy, just taking advantage of option premium occasionally. That's the intention. I wanted exposure to healthcare. That's why I bought THQ and UTF utilities, and it's currently running at a discount to its net asset value. ASGI has had a really stellar year, so I'm nibbling at that. And MLPI, which is from Neil's funds, is my midstream energy fund basically. And then you got SPY for the S&P 500, QQQI for the NASDAQ. And we're looking at what that would generate in income if you break it out on a monthly basis. They're basically, this portfolio is converting the quarterlies to what they would distribute on a monthly if you break it down. And so the total on a 200K investment would be 1,423 estimated, with a yield of 8.54%. And you can see what the distributions are relative to each one. So like I said, JAA is basically my AAA rated CLL fund, which I consider pretty safe, and JBB, not quite, about a medium risk, not a really mild risk, to be perfectly honest. Now the rates on these can change real easily if the Fed fund rate goes down. So I'm looking at, if there's a pullback in the market correction, it has to be like 20% almost for me to want to rotate out of these funds into my core, which, like my core, like I said before, basically going to be the engine right in the middle there: QQQI, SPY, MLPI, PFFFA, ASGI, UTF. That'll be my core. So this right here is just my backup kind of base for safety. And if we get a good 20% discounted market, I would definitely rotate. I'd go right into the engine of it and start laying out money on that. So like I said, these are my power players, my engine right in here. I got preferred stocks with PFFA. I've got my indexes. I got my healthcare fund, my energy fund, and then I got infrastructure and utilities. So I'm pretty happy with that kind of outlay. And the BDC thing, I kind of look as a liquid way to rotate money around and occasionally do options, because on my engine, the core funds that I want to keep, and even my base, which is like a rotational thing, I don't plan to ever do options on any of those, and really only the NEOS funds have options anyway, and I don't plan to ever sell them. But for the BDC sector, I'm okay with doing options on them, so I don't have any problem with rotating in and out of some of these. And so if you look at the tickers for ARCC, OBDC, TRIN, and HTGC, they have different payout dates, even though they pay quarterly. So if you look at it, every month of the year is pretty much covered by a payout from one of these funds. So that's kind of the caveat of why I picked them. And also, they're pretty highly rated for the most part, some with different levels of risk, obviously. And but they're going to be part of my will strategy. And I don't plan to will on a monthly basis. Just whenever I get a sign, I'll look at what it's doing on a chart, and I feel like it's pretty lofty, or I want to trim shares off. I might sell covered calls out of the money occasionally, stuff like that. Or if I'm not assigned by selling puts, I just continuously sell puts until I'm assigned. Anyway, that's my strategy going forward. I mean, everyone's got their own way of doing things. It's going to be my way of doing things. I own, let me see, I own all this currently. Actually, I'm in SGov for the anchor currently, but I'm going to rotate because the Fed fund rate's projected to maybe go down another half to a full point by the end of the year. So rates are going to be coming down on that. SGov is going to be paying less, so I'm rotating out of that as an anchor into JAA and JBBB. And my core of the engine, I should just refer to as an engine, is what you see in the middle there. If we get a good 20% haircut in the market, I'll rotate everything out of JAA and JBBB and be into the engine. That'll be my main holdings. And then, like I said, the BDC sector, ARCC, Trend, HTGC, and OBDC, kind of just going to will those from time to time, sell puts and sell covered calls. Anyway, I think it'll generate a pretty decent income. I might get actually beyond this at some point, especially if, well, like I said, if we get a 20% haircut in the market going in the near future, I'll be rotating, so that'll be potentially elevating this income despite things pulling back. Because if you think about it, with some of the NEOS funds like QQQI, SPY-I, and potentially MLPI during pullbacks, the optionality is going to be decent still because of the fact of the matter that volatility spikes will actually help these type of covered call funds. The premiums might actually go higher, because I think that happened back in April, matter of fact. I do got some close-end funds there with ASGI, UTF, and THQ, but they're pretty well allocated. They're large funds. And another reason why I picked these funds, the assets under management was important to me. I wanted to see growth in the assets under management. I was going to go with State Street premium income select sector funds, basically. But the thing is, they're not really growing. I want to see at least 50 million in assets under management, because you got to have some stability in the idea that the fund manager is profitable, that he has enough in assets to maintain the fund. And all these funds are got, significant assets under management. MLPI is well over 50 million in assets under management currently, and all these funds are tried and true. QQQI and SPY-I are around 7 billion or plus in assets under management currently. And that's why I just chose these funds. I want to make sure they're not going to be sold off on me at some point in time because the fund manager decided to close. And so that's why I'm keeping these funds primarily. And then I like the exposure to midstream sector, preferred shares, and infrastructure, utilities, and healthcare that I get with some of these other funds. All right, guys. Not financial advice, just something I plan to do, and how I'm going to allocate a 200K investment portfolio into my dividend portfolio. All right, guys. Take care.